All right, now 2009 will go down as the year of risk aversion and bargain hunting. At least that's what my next guest believes. Kirk Hartman is the Chief Investment Officer at Wells Capital Management with $375 billion under management. Kirk, welcome to the program. Good to have you with us.
Great to be here.
So explain this whole idea of 2009, a risk aversion scenario, everybody rushing, it seems, for bonds.
Yes, I think this year was characterized by a lot of risk aversion, which explains why treasuries, high yield, and municipal bonds have done so well. If you look at the other side, I think there's been a lot of bargain hunting in stocks where professional money managers bought at the bottoms. But if you do the math with stocks, if you're down 50% and you're up 50%, you're still down 25%. So the aggregate numbers mask the reality of what's going on.
Talk about this whole move into bonds for just a moment, because we've seen a flood of at least retail money going into bond mutual funds. Is there a trap there?
Well, I think you have to be careful. If you look at the LQD, which is an ETF that I recommended on your show about a year ago, it's come up about from 85 to 105, so it's had a tremendous run. I still think corporate bonds will do well, but obviously with that kind of run, you have to be very careful. Similarly with treasuries. Treasuries are very rich right now, and you saw it today when treasuries started to sell off. Individuals can get hurt unless they're going to hold the bonds to maturity.
Now, when you talk about holding to maturity, is there any maturity time that you're really looking for? Do you want to stay short term? Do you want to go medium? Or maybe even want to go long term in duration? Where do you want to stay?
Oh, you want to stay very short. I think the longer you go, the more duration risk you have and the more downside risk. So my recommendation is to stay very short. I think what's interesting is that money fund balances have gone up a lot. We're up to about $4 trillion from $2 trillion, even when money fund yields are practically zero. So it shows you that individuals are very happy to have their money in a safe place, even if they're not getting any yield.
What about looking to U.S. equities as a, maybe not a safe place, but a place for people to invest? Do you think that U.S. equities are a good bargain?
Well, that's a great suggestion. Actually, a number of my bond managers, when I asked them about relative value, pointed to equities. And they have said, look at the S&P 500 or even the Dow Jones Industrials. The S&P 500 and the Dow Jones Industrials both have a dividend yield of about 220. The 5-year Treasury is not far from 220. So the point being is you can buy some great large cap, what I call nifty 50 stocks, get a 2% dividend yield, which is what you're getting on a 5-year Treasury. You don't have the duration risk, and I think you have some upside.
What about the overall equity market? I mean, is that march higher in the United States? Because if so, then would you then consider small cap in order to maybe grab some of that higher risk, higher volatility trade?
Well, you could. Small caps have had a very large increase this year. I'm actually much more positive on the larger caps. I think this is the stock pickers market. So my view would be, especially for retail investors, I would stay with the bigger stocks that have the well-capitalized business models. I think this year stocks are going to be up probably 10–15%. S&P earnings in particular would be very strong, but I think it's a stock pickers market, so there are going to be some distinct winners and also some distinct losers.
Are we going to get, for example, a rotation that takes place in, let's say, the first quarter of 2010? Do people kind of move out of emerging markets and do just as you're saying?
I think so. Yeah. Look, emerging markets have had a terrific run. Emerging markets this year are up something like 75%.
And great for the decade, too, right? I mean, you take a look at the markets there.
Right, fabulous for the decade, but especially this year, a lot of that is currency driven. So in other words, if you take out the effect of the weak dollar on the gain, it's not nearly as much. Now, having said that, I think emerging markets are longer term are going to be a good play because money managers only have about 3% invested overall in emerging. In Europe and the United States, only 3% of professional money market aggregate investments are in emerging market stocks. So longer term emerging market stocks are going to do well, but in the short term, I think you have to be worried about the currency effect.
All right, and so that might actually pull those emerging market stocks even higher as more of those people look to those areas for growth.
Yes, longer term, no question about it.
All right.